Hello everyone and welcome into Fonterra's 2015 annual results broadcast. With us today, Chairman John Wilson, welcome John. CEO Theo Spierings.
Scotty.
CFO Lukas Paravicini, welcome
Scotty.
Lukas. And the Shareholders Council Chairman Duncan Coull, welcome Duncan.
Thank you, Scotty.
So much to get through today, gentlemen, but before we start, before we crack on, John, firstly to you, a new milk price today.
Yes, Scotty. So we've had a look, our management team have had a look at how prices have lifted so quickly since July, and our farmers have all seen that through global dairy trade over the last two events. We've forecast forward on our likely production for this year. We have had a decrease in milk production quite dramatically, tough weather conditions on farm. There's less cows out there, less supplement being fed in a rapid response to these tough economic conditions. So we're actually tracking 8% behind last year on a week-to-week basis. Our forecast for the year is now 5% less production, at least for the year ahead. It is early days, but looking at the increase in price so quickly, we've lifted the milk price by 75 cents to $4.60, and we've still got our expected earnings available for payout at 40 to 50 cents. So that's available for payout at $5 to $5.10. So that'll be pleasing for our farmers given how tough it is on farm.
Yeah, I'm sure farmers will welcome that, but there may be some out there who are saying a little bit too soon, perhaps.
Our management team and certainly the board are very conscious of so much volatility, and we've gone from $5.25 to $3.85, now we're at $4.60. But we've got enough confidence in what we've seen in this lift up, and we're taking a conservative view looking forward as to where we see things happening at the moment.
It's pretty good news looking forward, John, but after a tough season, how would you sum up the past season's results?
Good performance overall. We will deliver this year a milk price of $4.40, so we've been able to hold the $4.40, and we've been able to pay a dividend of 25 cents. So available for payout, $4.65 for a 100% shared up farmer. So very much on forecast, and so I'm sure our farmers will be pleased to see that. It has been a defining year for the cooperative though, significant investment and capacity over the last 3 years, and also investment in being made in China, investment in completing our farms in China. So very much a defining year for the future. So pleasing to hit the $4.65. I should say the 25 cent dividend, board thought about that very carefully. It is right on policy within our 65 to 75% policy. And so on that rolling average, that's where we're tracking at the moment.
Before we go into too much detail, let's come back a little and look how the market impacted on total cash payout.
Well, the biggest driver for our farmers in milk price, of course, is global commodity prices. And we've seen them drop dramatically during the season that we've just finished. So that has been the biggest impact. I need to comment also that the other big impact is on foreign exchange. And our Treasury team have done a good job this year. Not only have they been confronted with falling revenue, which they've had to manage, but also exchange rate, US dollar, New Zealand exchange rate also dropping quickly. And so revenue and exchange rate have been managed as per the policy within Fonterra. And look, on balance, they've done a good job. We have had short-term costs because of our investment in plants, because of our investments in our key strategic markets. That has certainly had an impact on our interest costs for this year as well, and that's impacted in our final decision on the 25 cent dividend.
Theo, time to bring you in here. Let's go through a headline performance. Theo, headline performance numbers from you, please.
Yep, sure. And headline performance, you want to talk about the things you can control and not the things you cannot control, but John has touched upon the world. But in the things we can control, you see along the strategic approach of volume, value, velocity, that volume up to 4.3 million metric tons, 9%. When you look at the revenue line down 15% because of what John touched on, drop in commodity prices. We consolidated DPA as well, Brazil, so that was a bit of a compensation. But on the profitability, really strong results on ingredients. Yeah, really the highest result in the last 5 years of 973 million, return on capital of 9.3%, consumer food service a result of 408 million, 25.5% return on capital. So really strong performance, but predominantly driven by the second half. So we are happy about the second half. The first half we have spoken about.
as Theo and John have both touched on, Duncan, it was a good performance in the second half. What do you think the farmers will make of it?
Thanks, Scotty. Yes, a solid improvement on the first half of the year. However, I think overall farmers will be somewhat disappointed with the dividend, which fell below their expectations. And farmers expect this strategy to deliver returns which reflect their investment in the co-op.
John has talked about how the co-op has invested heavily here, Lukas, in capacity, around 900 million, primarily in new projects and maintenance. What's driven this business strategy?
Good point. Indeed, we have invested significantly this year, as John pointed out at the beginning. And I think we need to go back and look at the milk solid growth over the last few seasons. That's been 10% since 2012-13 season. This year, we have actually concluded and commissioned our Payatua dryer, which has consumed $167 million. We have also invested roughly $132 million in our Edendale plants to ramp them up. We have also started our Litchfield dryer investment with another $122 million, which will commission in 2016. All these investments have actually driven our capacity over 8 million additional litres with these investments. I think what is also important, we have continued to invest beyond our capacity, which gives us this optionality, the possibility not just to take that additional volume, but also to be able to always use the best stream returns, or even better than we did in the past. But very important also, it drives efficiency, scale, and therefore will also drive cost down. As I mentioned just before, we also have invested in our key market, China, which is key to our strategy, both by continuing on our farm development, but also into being made, and Theo will touch on China later on. That was very important to us. We also have, throughout the year, supported farmers with the advance rate. As you remember, we started off the year with 64% advance rate on a $7 milk price. Throughout the year, the board and management elected to actually continue with that advance rate and not pull back on that, which led actually at the end of the season with a 900 million higher advance rate. All that has consumed funding. We can see that all this investment in capacity in number one market and also the advance rate, let's be clear, has increased our funding costs by $95 million, or 6 cents per kilogram milk solids. That obviously that capacity investment, the strategic market investment, the advance rate has had an impact, as I mentioned to you, on the funding, the interest cost, but also on our gearing ratio. It has gone up to 49.7%. I think it is important that we highlight that in those 49.7%, there's a timing issue. The advance rate to farmers is really a timing issue, which will go away in the next few months, but it is important if you compare to last year that you consider that timing effect. You take that timing effect out, it actually drops to 46% of gearing ratio.
Okay. Lukas, a lot to take in there, and I want to come back to you, John, if I can, because a lot of investment in capacity here in New Zealand. I guess the question is, given the market conditions, has it been a little bit too much?
Life's all about timing, Scotty, and the reality is that we've had so much milk off farm, 4.6 to 4.7% milk growth off our farms over the last 5 years, and we commit to this capacity build well in advance. And in fact, we haven't had the capacity in place early enough, and it has significantly cost us at peak, and we haven't been as efficient as we can be, which impacts our profitability, which impacts our dividend. So it's been important to get this capacity built, and we're in a good position now when we look forward, and you will see our capital expenditure drop dramatically. We've just got to finish the Litchfield build, and it will drop dramatically over the years ahead. So you've got to plan in advance. It was important to get this capacity built. In actual fact, we've been tracking up, and it's cost us. What's going to be important is that this is the first spring for a number of years. We've had these big builds going on in Pahiatua and Edendale. The milk will be flowing through them, and that will be very helpful for profit.
That's the New Zealand investment. What about China, though, Theo? There are investments there. Can you update us on those?
And of course, what John has said, for us it's always crucial that the investments at home in capacity, but also food service, because we have a unique position out of New Zealand in food service, that always has priority one. But in China, I mean, we have a favorable trade agreement as New Zealand, very favorable. And it's very clear from Chinese context that they've always said from day one, at least day one that I was talking to them about Fonterra, that you need to be present in farming and you need to be present at the consumer side to really play a role in consumer food safety, right? And therefore you see investments, and indeed significant investments in our farming operation there. Yeah, we have completed the second hub, actually going very well, way over 50,000 animals at this point in time, about 200 million liters of milk. So that's going well. High quality milk, which we sell to our key ingredient customers. On the consumer side, we have launched Anchor, we have launched our N-Mum brand, but can we do that really without partners? We cannot, yeah, because we have launched Anchor in 2013 and N-Mum the same. And we need partnerships, and we have always said that. And the Chinese want us to also develop those partnerships. So the partnership with Being Made is the partnership in infant nutrition with the #1 player in China. So it's a very strong partnership in a product category where food safety and quality, baby food, is extremely important. And that's completely in line with what, let's say, the government of our #1 country around the world really requires from us, or wants from us.
John, I want to bring you back here because plenty of investment, and there's a cost with that investment, but any businessman and any farmer wants to know, is there a return on that capital?
The answer is yes, and our farmers know there's been significant volatility this year, and we talked about that a lot in the first half year, which has impacted our results, but it's just been touched on. 8.9% was our return on capital, which is a pleasing result. But what was very good was that we've seen a significant lift in our return on capital in the ingredients business to 9.3%, and our consumer and food service business at 25.5%. So certainly good progress from last year when we had the significant changes we had to make last year.
Let's go back to on the farm, and before we get into even more detail on their results, how good a year was it for farmers? I know we've had some mixed conditions, we've had drought, we've had flood in parts, but production overall, how was that?
Yeah, so typical farming year in New Zealand, some ups and some downs, but we're 2% up. We're now over 1.6 billion kilograms of milk solids, so 1.614 billion kilograms of milk solids for the year, 2% up.
Theo, strategy is all about volume and value, has been for a long time here. So can we go back to the overall results and take a look now at how that was achieved against those goals?
There's our segment reporting. So we would like to talk in our ingredient business, consumer food service and farming. So in the ingredient business, really an outstanding result across the year. Although first half we had an inventory impact, we've shared that with our farmers, but second half extremely strong. So driving a number of 973 million EBIT in ingredients, that's 9.3% return on capital. That's the best result in the last 5 years. On consumer food service, really across the board, except, I must say, except for Oceania. Yeah, we still struggle with volume and value growth in Australia. New Zealand recovered very well, but all the emerging markets really double-digit volume and value growth, resulting in 408 million EBIT, 25.5% return on capital. So that's really a very strong performance, mainly driven by the second half.
The ingredients business too would improve margins up 264 million. That's a fantastic result.
Yeah, and that, of course, that value is created by shifting volume to higher value, because our overall volume declined because we shifted also volume to consumer food service. Yeah, but that's our strategy. So it's not so bad that you see negative volume development on ingredients, because your lower end ingredients you want to shift to higher value. But a lot of value created in the ingredient space with our customers on the innovations, yeah, but also price achievement. Really strong relationship with our customers all across the globe.
It's good work on performance, really, John, but were there other highlights that stand out for you, given the fact that this was a tough, mixed season for farmers?
I'll just say one thing on that performance, and Theo's touched on it. We've still a lot of work to do in Australia, but certainly across the business, we're certainly comfortable with where the year played out, given how difficult it was in the front half. Look, it has been pleasing in some of the other work that we've done with our farmers. I've talked a lot about solutions rather than problems, and we've seen our team, the new appointments of our regional leaders. We've seen a lot more connection in the regions with our farmers through our Shareholders Council alongside. And what has been a very difficult year for our farmers, very anxious about cash flows and challenges on farm, particularly the last couple of months. Being able to provide that service in the regions and far more regional focus, I think has been very, very significant improvement this year. Change in technology platforms, so more apps coming to our farmers for those that use that technology has been very pleasing as well. So look, I think as far as getting closer to our farmers and working with our farmers and making information available, on balance, significant improvement in the last 12 months. And look, pleasingly, the uniqueness of the cooperative in this extraordinary situation with such a low forecast at $3.85, to be able to announce the 50-cent loan and be able to deal with that. We will review it again in December, but I think that has been a very critical role that the Co-op's been able to play to be able to support our farmers at this incredibly difficult, challenging time with prices so volatile.
Well, thanks very much, John. Look, Duncan, a very positive response from the farmers, given conditions. Is that your take on the Co-op support from your point of view?
Yes, very much so, Scotty. Farmers appreciate the package, and many are taking advantage of it. At last count, that was well over 7,000. There's no denying the current situation is extremely tough on farm and farmers' cash flows, so it's really good to see the Co-op doing all it can to lend a helping hand to our farmers.
Theo, nice supportive words from Duncan there, but do you believe the cooperative really has strengthened this year?
Yeah, I think on what Duncan is saying on that side, if we would not have improved in terms of working capital around the globe, then that money is simply not available to launch a support package like that. So, but that's more on the working capital side. I think when you look at the business, so volume, significant volume to higher value, there's clear evidence in all regions, especially in the emerging markets. And what I said before, in our ingredients, we're really moving from that, I would say, more product focus to the customer focus. And in the customer focus, there is definitely value. So I think those developments are really good. And of course, the 25 cents of dividend is in the middle of the bracket. But Lukas has also explained that investments in the future of the Co-op, which are very important, that is 6 cents, which are invested in the future rather than in the payout this year, because you need to really look at the long-term future of the Co-op.
Theo, it's interesting stuff, but I want to bring you back in here, Lukas, because what is the key message financially about where the cooperative is right now and where the cooperative is heading?
I think it's very important that from a financial point of view, we have to recognize that, yes, we have set us up for the future. We have made sure that we can continue to harness the earnings per share going forward. But that has required a significant investment, as we have pointed out before, that has had an impact on our gearing ratio this year. And it is very clear to management, also guided by the board, that we will continue to now focus on our financial discipline to make sure that we come back to our normal gearing ratio and other metrics we use to explain the financial discipline. This is through executing our strategy as we have done before, but also with our business transformation, we'll accelerate that process, and that will not just provide further input to our earnings, but also will make sure that our gearing ratio and financial discipline is improved significantly.
Thanks very much for that, Lukas. Duncan, back to you. And given what we've heard here in this announcement, and given your relationship with your farmers as a Shareholders Council and as the chairman of that council, will you be encouraging your farmers to get along to these meetings this week?
Yeah, thanks, Scotty. Very much so. Driving participation is a key function of the Shareholders Council role. Next week's meetings being no different. So this is one of the very few opportunities farmers have to engage directly with board and management. And so I encourage them all to get along to these meetings. Given the current environment, I'm confident that farmers will be forthcoming with questions to board and management.
Thanks for that, Duncan. John, back to you. And here's the big question. I'm sure farmers want to know if what we saw in the 2014-15 season is going to repeat itself this season.
Oh, we expect it to improve, Scotty. So the second half of the year was a lot better than the first half, and we see that in our forecast earnings for this year at 40 to 50 cents, so a significant step up from the year that we've just been in. Our reality is, if you look around the world, still a huge amount of volatility. We're watching the markets of Brazil, China, East Asia, critical markets for us, which are all going through demand drop-off at the moment, so we're watching those. But we do expect that the supply-demand balance will realign over the coming 6 months, and we're seeing that at the moment with prices starting to move up, certainly on the back of what we believe will be a lot less production out of New Zealand and potentially other markets around the world. We're seeing European farmers, of course, protesting on the streets currently because of low prices, and so we would expect that to also impact milk flows. So that's why we've upped the milk price to $4.60, available for payout therefore this year, $5 to $5.10. And we will update farmers as we see those numbers change during the year. It is very volatile, but our management team are absolutely committed to watching those numbers, and if we see that price move over that 30 cents level, as soon as we're able to, but we're forecasting forward a long way at the moment, we will update our farmers. I just want to reiterate what Duncan has just said. Very much encourage our farmers to come along to the meetings next week. There is a lot to talk about. I know our management team, certainly all of the board, are very much looking forward to next week. It's a great chance to connect with our farmers and talk about what is just a really difficult market to predict at the moment, but also a year in which Fonterra, quite a defining year for us. Yes, the dividend isn't as high as what we would like, Scotty, but as has been touched on, significant investment for the future, and the business is in good shape for the year ahead.
Thank you for that, John. As always, thank you. Theo, thank you. Lukas, Duncan, thank you very much. Thank you to you at home too for watching, and don't forget to get along to your local meeting. They are your meetings. Bye for now.